This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today, he's chairman and CEO of Lloyd Jones. Since 1990, he has developed, owned, and managed approximately $1.2 billion in multifamily real estate. He was a former commercial airline pilot with Eastern Airlines. He resigned from Eastern in 1983 to focus solely on Finlay Company. His name is Chris Finlay. He has more experience in real estate than almost most people I've ever met, to say the least. But he expanded to add real estate development and focus in 1990, created approximately 40 multifamily senior housing communities, as well as luxury condominiums. Since added senior living, a major focus on senior living right now. And you're going to hear us talk about that during the interview. He's going to elaborate on why senior living. He's got 40 years in multifamily, but he has now pivoted. Obviously, that's come with a lot of focus, a lot of intentionality. He's going to make a few points that I know you're going to learn from today, and going through, hey, why make that pivot? Why now? Even talking about investing, messaging to investors, making a pivot like that internally, it's a big deal, right? To make that happen, and the teams required. Even how he has found and built some amazing teams. You're going to learn a lot from Chris today. Not every day I get to have somebody on the show that has a level of experience as our guest today. I'm excited about this interview and discussion with Chris. Chris, welcome to the show.
Thank you. Great to be on.
Yeah, honored to meet you and have you on. And just reading a little bit about you, I'm excited to dive in a little bit. I know the listeners want to know a little more about who you are, though. Give us a little bit about the 40 plus years in real estate. Why? I guess a little bit of how, right? You get to where you're at now. Why real estate in the beginning? I know you didn't start there, which we talked about in your bio a little bit. I know you started as a pilot, but let's talk about that transition a little bit. But then, man, so much experience to go through.
Sure. Well, I started out as a pilot for Eastern Airlines, and the great thing about that is that in those days you flew about 2 or 3 days a week. 3 being the most, and so you either have a hobby or you get into some other businesses on the side, and a lot of pilots do that, and so or investments on the side. So I went to work for a company. I got the opportunity to work for a commercial brokerage firm in Connecticut, and got my feet wet on that, and continued from there, and then moved on up to New Hampshire and opened my own company in 1980, and started my own firm.
So you were working, you said like 3 days a week as a pilot, but then you had this experience to be able to learn about this on the side, really.
Correct. Yeah, it was great. And then my father-in-law also was in the business, and I kept bugging him about how do I get in on some of his deals. So we finally, he got me in on an avocado grove down in South Florida years ago. So turned out to be a great investment, so I was hooked.
That's awesome. Wow. What you opened your own firm in 1980. What was the focus then? What was your plan? Was it to be, grow a massive real estate firm? What was your thoughts then on what, your business would become?
Yeah, well, I was in commercial brokerage down in Stamford, Connecticut. That's a big city and really suburb of New York City, really. And so what I wanted to do was sort of go to the next tier of the suburbs. So, that market down there is very, very big and sophisticated. It would take a lot of capital to start a shop there. So I moved up to New Hampshire, and we opened our first office in Portsmouth, New Hampshire, which is, like I would say, 50, 60 miles north of Boston. So, and then in those days, back in 1980, in those smaller markets, there weren't commercial real estate brokerage firms that were exclusively commercial. It was usually a residential firm that would have 1 or 2 people doing commercial. We were 100% commercial. So probably the first in New Hampshire to do that. And then we brought with it, the sophistication and the data and all that stuff that, the big city guys do. So, we were trying to be the big frog in the small pond.
Yeah. Wow. And how long, were you as your own brokerage firm and then moving up to Lloyd?
Yeah, we started out at brokerage, then we moved into appraisal and also property management. And in those days, the management was really all classes. We were brokers in all classes. So, we grew all three of them. And that served us really well because the late 80s, early 90s, we had the Great Recession. I mean, it was the S&L crisis back then. All the banks were closed. We became one of the largest asset managers for the FDIC in the Northeast. And a big part of that was the fact that we had both a brokerage arm, a management arm, and an appraisal arm. So, so those three sort of, different categories really helped us, in up and down markets, and proved pretty good.
Yeah, for sure. And then you made transition to Lloyd Jones, right? And running Lloyd Jones.
Well, we were the Finlay company, so we were those three companies until about 1990, and then in 1990 we started developing multifamily, and primarily using the low-income housing tax credit, and that business really took off. We also started our own construction company as well, so we had both construction and development, and that was really sort of our focus, the development and construction of multifamily all the way through 2010, and that's when we moved into investing, primarily investing, not building, because after the other recession, the 2008 crash, it really made sense to buy and not build, right? I mean, you could buy assets at a significant discount, and so we moved into the investment side and invested, mainly on our own account for several years. And then when we decided to bring in outside money, we didn't want the confusion of having that money with the Finlay money, so we came up with the name Lloyd Jones, which is my grandfather and great grandfather, and we went as Lloyd Jones.
Love that. I love that the name too, or how you came up with it. That's fun. So, but you said 2010 moved more into investing instead of building. It was the time to buy instead of building. But then you still you're buying multifamily, right? And sticking with multifamily. But then more recently, you've pivoted. Is that right?
Correct. Yeah. So we've been in multifamily since in the investment side of multifamily since 2010, and then in 21 we pretty much sold, I would say 85% of our multifamily. Coming out of COVID, there was such a pent-up demand, and there was so much capital on the sidelines because obviously all the big funds and investment firms were pencils down all through COVID, and nobody bought anything. So once everybody felt we were out of that, the market, as you well know, went crazy. And the numbers went crazy, and so I saw that as an opportunity. I just felt that it was, there were crazy numbers, right? When I was getting a 3.5 cap for a B property in a small town in Florida, I said, it's time to sell everything. So we tried to sell everything, but we got about 85% of it sold before it started trending down again. And so we were pretty lucky on the exit side of that. Then what we've done since is with that capital, we've redeployed that into senior housing. And what happened with senior housing is you have a huge demographic wave of baby boomers coming at us, right? And so everybody knows the demand side. And let's face it, demographics is the key to real estate, right? So that segment of the population is just massive and going to increase. And we had been looking at it for 4 or 5 years in depth. I personally developed and own an assisted living and independent living up in New Hampshire. I've owned it for like 25 years. We developed one, and I was all excited about it back then, and did very well. And I said, "Oh wow, I'm going to do more of these." Then the market crashed. And so, it's that segment of the business, the population is so thin that it was boom bust. And, just prior to COVID, we were looking at it again as a strategy. And especially since we sold the multifamily, we just felt it was ideal. And it was a little soft and a little overbuilt prior to COVID. And so we would, put a team together and was really getting into it. And then boom, COVID hit. And of course, everything came to a screeching halt. And so when we got out of COVID back in, say 21, end of 21, 22, we really felt that there was a great time to buy. And tragically, every owner in senior living was clobbered by COVID. I mean, you could have been the best in the world,
Yeah.
or the worst in the world. Uniformly, you got decimated. I mean, it was just tragic what that did to that segment and industry. And not as badly as skilled nursing facilities. They were the absolute worst, of course. And then it trended down with memory care, assisted living, independent living. And so, so when they came out of COVID, these companies were really, really in trouble. And, last year we bought 12. This year we got 3, but the market now is getting tough because of debt and equity is getting tougher and tougher to make these things work. But it's still probably our focus. I mean, we'll always be in multifamily is an excellent asset class. It's without a doubt the best probably. But right now we think that there's a unique opportunity in the senior space for those people that know how to run it. And that's the key to the whole equation there is you've got to be able to manage these facilities. And that takes a big operating platform.
No doubt about it. I appreciate just the color and the timeline, the picture that you paint. I think it's so helpful to think through, man, your all's experience in multifamily. I would say, some would say, well, why wouldn't you just keep focusing on multifamily? Y'all done that for so long. You know that so well. You do see, is it shiny object syndrome or no, how did you know to pivot, right? Away from this thing that you all have been laser focused on for so long?
Well, if you look at 2010 to me, presented a unique opportunity to invest in multifamily, right? Before that, we were developers and before that, investing in multi was good too. I mean, we built them and owned them and operated them. So in essence, we were investors as well. But 2010, because of the crash in 2008, the financial crash, there was here again a sort of outside event created a tremendous opportunity to invest. It destroyed value, right, and it created a really outside return possibility by buying those assets at such a steep discount. So we pivoted there and said, okay, we're not developing. We shut down our development operation and we bought existing assets. To me, this is 2010 for seniors. And, instead of it being 2020, because of COVID, it's been delayed a couple of years. So call it 2022, but it's the same dynamics that happened in the multifamily space. You had a financial crash here, you had a COVID crash. And so that specific asset class was decimated. And now we're buying assets at 50 cents on the dollar. It's unbelievable.
Wow. I guess, how do you know, like another, tragedy, like you talked about, like a COVID, won't come and happen again and decimate that asset class?
Sorry, what was that question again?
Is that you talked earlier about, just the tragedy of COVID and what that did to the senior living, asset classes, and just, no matter who the operator was, how do you, I guess, prepare for a potential crisis like that again, in that asset class?
That's a great question. I mean, you hope like hell it never happens again, right? So, certainly it's a higher risk class, and it certainly sells at a cap rate that rewards that kind of risk, right? So it's far more operationally intensive than multifamily. My thought is that there's such a dynamic, it's such a unique situation where you have such a massive population growth into that category, and a market event that caused substantial discount, and you had the same sort of thing happen with the millennials back in 2010. So if you look at the millennial, demographics, 2010, they shot up like a rocket, right? And then they wanted to get out of the basement, Ma's basement, and get into their own apartment. And so multifamily 2010 to 2020 was just unprecedented growth, right? You pretty hard to mess up. I think going forward, it's going to go back to a more normal, stabilized market. There's still going to be growth, but some markets may get easily overbuilt, and so it's going to be, you're going to have to be much more careful in that space. Whereas I think with senior, we're going to just see a tremendous growth.
Yeah. Yeah, no, I appreciate that. I know that's a question listeners have. But yeah, it's interesting in the transition too, you need more staff to run senior living facility, right? I mean, it is, much more, it's differently operated properties. I'm sure most of the listeners are aware of. Speak to that transition a little bit too, just the operation side of that kind of business, and undertaking that, moving to that asset class from multifamily.
Yeah, exactly. It's all about operations. So when you look at multi, I would say real estate is 90% of the equation and 10% is operating it well. And the operations side is pretty simple. It's not rocket science. When you look at senior housing, it's 90% operations and 10% real estate. So 100-unit property, you'd have 60, 70 employees, full-time employees. Remember, you're 24/7 here, so you've got people around the clock. You're providing medical care, you're providing food, housekeeping, the whole thing. I mean, it's just a significant operational platform that you have to create to be able to operate these. And so, so when we started back in, when we were looking at this business in 2020, we started acquiring some top talent in preparation for building out that operating platform. And then after COVID, what happened was there were a lot of companies that were in trouble. Several of them have shut down. And so the opportunity that presented me, Whitney, was now I can get out there and attract and recruit top talent because it's available. Just because of what they've gone through, again, COVID, and the disruption and distress that caused, they put a lot of top talent out there available to a startup like us. And so we were able to put together a tremendous team and be able to execute on that strategy.
I like the planning and foresight that you had as far as, you said you started hiring for this what, 2 to 3 years, before actually acquiring, and
Right.
finding that talent. And even your, the thinking now, well, now's the time to hire for this because of what's happened. And, yeah, I just thinking through that, as you were planning this years before, and preparing these teams, are you all managing all these in-house as well? I mean, are you all doing all the internal operations of these facilities?
Yeah, absolutely. 100%.
And so I think it just shows the stress on hiring talent, right? Moving into a different space like that. So, and there's so many questions we could I think through, but who was your most important hire to shift in this asset class, bring in internal operations for these kind of facilities? Who was the most important, maybe top 1 or 2 hires to make that happen?
Well, number one is your head of operations, right? So your chief operating officer, and that person we hired from one of the top premier companies in America. So you bring in somebody like that. The second most important person in this space is your national EVP of health and wellness, and that's a person on a national level that basically oversees everything you have everywhere. And that's a really very important, because all of these facilities are licensed. There's a ton of regulations that apply to it. So the health and wellness part of this really becomes critical. And if you mess up, not only can you cause somebody harm, but you can ruin your reputation and run into serious problems. So having the right health and wellness director and making sure you have the controls in place, the training in place, and all of that is critical. Then on top of that, you have regional vice presidents, but you have national. We have a national head of sales, a national head of marketing, a national head of dining. So food to these folks is really important, and and so. You've got to have really great dining operations and that kind of thing. So, so you have to build sort of a national platform first. And then depending on where you buy these assets, you then have another regional level below that, so that you would have a regional operations, a regional sales, and that kind of thing. So it's a pretty big, big operation.
Well, you found them from some of the top competitors, right? Or top players in the industry. It sounds like, found them.
100%. Yeah. We've been so fortunate to be able to, and our goal and our strategy there is that what we've tried to do is, rather than just go to like what we consider maybe the best company, we got our COO out of the best company, I think the best company in America. And hopefully we'll be as good as they are one day. But what I purposely tried to do is take, say, the top 5 companies and pluck one person, one key senior leader out of each one of those, so that now we're a startup with some of the best minds of the several companies, right? So we can take the best practices out of A and sort of merge them into B and C and so forth. So now we sort of, regurgitate all of those great strategies, great ideas. And so it's really fun for me to try and, put that team together and have them all put forth. This is how we did it at this company. This is how we did it at that company. And so we can have some really good dialogue about, okay, let's tweak this, let's tweak that, and come up with something better than all of them.
Love that. One more question about the transition a little bit, but even messaging to investors, any tips that you would provide on the operator that's listening now that's, hey, they're going to pivot as well, but maybe they're concerned about, just investor facing, right? Well, moving from one asset class to the other.
Yeah, that's a very good question. So, we've had so long a history with investors, and up until very recently, all of our investors were institutional investors. We did joint venture. We didn't do syndication. We did joint ventures, and we had one partner in each deal. and that one partner would normally write a check for 90% of the deal. So that was our structure, and convincing those guys, first of all, they're very sophisticated investors, right? and so convincing them that we knew what we were doing was very difficult. So what I was able to do is take the capital that we had, the money we've made off of selling our portfolio, and then rolling that into other assets. And then we had some family offices that had been with us on a number, for a number of years. And these are very big $billion family offices. And they liked the strategy. And I think they took a leap of faith on me and said, Chris has made us a lot of money in multi, and hopefully he's smart enough to make his money. So, but the big institutional guys are still there. I mean, they want to see sort of proof of the pudding. And we'll have that pretty soon. I mean, we all, everything we bought was really a turnaround situation. And so it takes time to execute on that plan. It's not a 3-month plan, it's a year, 2-year plan. But as long as you can see that steady progression. So I feel comfortable that, I feel comfortable when the market turns and these big guys get back to investing, which they're not doing now, we'll have a track record to show them. And they all love the strategy. These guys are very smart on this stuff. They do a lot of research themselves. And, I've done a couple of road shows up in New York in the last few months. And universally, these guys love the strategy, right? But they're not investing right now. With me or anybody else for that matter. I mean, most of them are pencils down until they figure out what's happening in the economy.
Wow. And no, it's incredible. I just thinking through the messaging to, if we made a pivot like that, how I would think through messaging to our investors. We're not at the moment anyway. What about, what's your best advice for passive investors right now?
For an investor or
just passive investors right now.
Yeah. I think, I think we're in a very difficult time, and I think you need to be very, very careful. Obviously who you invest with is very important. So if you've invested with a sponsor that's done a good job, you just hope that they have the ability to adjust to this kind of market. As you well know, debt is very difficult. Instead of 30% down, you need 50% down at least. And so I think you need to be cautious. I think, none of us know what's going to happen, but I just think with the interest rates where they are, the economy where it is, I think you have to be very careful right now.
For sure. What are some of the most important metrics that you track, Chris? It could be personally or professionally.
Well, I would say professionally, you mean for a business strategy?
It could be the number of mornings you get out of bed on time. It could be how many deals you all are looking at.
I definitely don't track that, but I don't have any trouble getting it. I wake up naturally about 4:30 or 5, so without an alarm clock. So anyway, no, look, I think for me, from a real estate investment perspective, demographics means more to me than almost anything else. So. And let's face it, the population is increasing, and I certainly think the senior generation and that demographic is going to just provide a huge impetus. I also think from a multifamily point of view, more and more people are going to be priced out of the single family home ownership model. And look, if you look at other countries, Europe and so forth, large number of those people rent, and especially since now build to rent, single family duplexes, that kind of thing is becoming very, very popular. And I can see why, because I think there's going to be a lot of people that are priced out of owning, and that's going to be the best option for them. So, but demographics is really where I look at it, and then you see things in the economy like I was just mentioning, where costs and interest rates are going to preclude people from buying. So, I think the multifamily, and that's the build to rent market is certainly going to be there in the future, and it may be the only alternative for a lot of people.
Chris, what are some habits, daily habits that you're disciplined about that have produced the highest return for you?
What was that again? Sorry.
Just some habits that you are disciplined about that produce the highest return for you. It's like, I know if I've done this over the years and this has proven to be so valuable.
Yeah. Well, I wake up very early, usually 4:30, 5 at the latest. And then I usually try to, take some time to be quiet and think and plan my day for about an hour. And then 6 a.m. I shoot out and try to walk about 4 or 5 miles. And that sort of allows my brain to get working and start thinking of what needs to be done. But I think how you start your day is very important. So, so that's a routine that I do, 7 days a week. So it's non-adjustable at my age.
What would you say is the number one thing that's contributed to your success?
I think putting great teams together. I think the key to business is nobody can run a business by themselves, right? And even if you're a very small business, chances are you need some help, and you need a team. So I think it's very important to be able to find great talent and get them into a team environment and support them. And that's the key to all business, I think, not just ours.
On that note, I wanted to ask you a minute ago. You talked about hiring these people that are from top organizations. Can you speak to just attracting them? So it's like they're leaving probably, a place they've been for a while and they're established there. And then they're going to, attracting them over to you and them having the confidence, I could see being a challenge. How did you do that so well?
Yeah, I think that, the key there is, top talent wants to be able to have a big impact, right? So if they're with the big company, chances are it's on the rails and it's going to stay on the rails, right? And so they can join a new company like ours, and they create it, they help make it, and they help, be able to have much more influences to how we execute on the strategy. So I think, recruiting top talent to a startup is easy, really, because they love the challenge. They love to be able to have that sort of impact and be able to, sort of execute on their vision as well, where they wouldn't get that opportunity with a great big company. Even if they go to the very top, there's a board of directors that are saying, no, you can't do this, or you can do this. Here they have a lot of ability to be able to execute on the plan and have a lot of input.
Love that. Chris, finally, how do you like to give back?
I think, first of all, I give to several medical causes, and then I think what I've done all my life, well, not all my life, but all my business life, is I've always brought in a bunch of young people right out of school, right out of college, and when I look back, I think I've trained and sort of helped some of the best players in the country right now. So, and I still know them. We still talk. And so most companies my size would say, hey, that's more trouble than it's worth. And, it's really, these big companies can do it easily because they have, a huge infrastructure and so forth, and they can bring in all these analysts at a low level and so forth and recruit. What is it? Blackstone recruits 150 new analysts every year. But we've done that over the years, and I think it's really been rewarding to take sharp young people right out of school, give them an opportunity to learn and grow, and many, if not most, have moved on and done terrific. So most of the big PE firms, I have somebody from my company working there.
Yeah,
So
that's awesome. It's such a great way to give back, right? Man. Appreciate you doing that. Appreciate you giving back to us today and just being willing to share so much of the lessons learned and years in multifamily and even pivoting and why and your thoughts about senior living and even the 2010 for senior living. Love that thought process. But you taking action on that, I think it's a great example for each of us as well. And many times that you've took action and transitioned and you've done well at it. So Chris, thank you so much for your time today. How can the listeners get in touch with you and learn more about you?
Yeah, well, LinkedIn, Chris Finlay on LinkedIn at Lloyd Jones or LloydJonesLLC.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.